silver prices experienced a sharp and rapid move during the latest trading session, reaching a high level early in the day before reversing abruptly. According to market activity, silver surged to approximately 82.75 before falling quickly, dropping back below the 79 level within hours. The reversal followed a period of heightened attention triggered by a bullish headline that circulated widely. As buying interest accelerated, selling pressure emerged just as quickly, leading to a sudden decline. Market data confirms that silver reached the low 80s before reversing decisively. The pullback occurred near a previously established high, an area that has historically acted as a point of resistance. The speed and intensity of the reversal stood out, particularly given the enthusiasm that preceded it. The immediate question facing market participants is whether this movement represents a routine pullback within a broader upward trend or the beginning of a more significant downturn. To understand the move, it is necessary to look beyond short-term price candles. Markets respond less to positive headlines themselves and more to positioning. Price movement reflects who needs to buy, who needs to sell, and how liquidity is created or removed at key moments. In this case, a bullish report released by a major bank drew widespread attention. As the headline circulated, social media amplified its impact, and buying activity increased rapidly. Prices moved swiftly toward the 83 level. At the peak of enthusiasm, selling activity increased sharply. The market reversed without hesitation. The sequence followed a familiar pattern in which increased demand creates the liquidity necessary for large sellers to exit positions. Rather than selling directly into a thin market, larger participants rely on increased participation to distribute positions efficiently. This process depends on drawing in buyers first, which the headline successfully accomplished. This type of movement is commonly described as selling into strength. The headline created urgency and attracted buyers who feared missing the move. That urgency provided the liquidity needed for distribution. The resulting decline was not gradual. It was fast and forceful, indicating that stops were triggered and positions were unwound quickly. The speed of the move suggests a deliberate clearing of positions rather than a slow shift in sentiment. The reversal occurred near the same price zone where silver had previously failed to break higher. This area, around the 83 level, represents a known point of resistance. Price memory plays a role in market behavior, as both traders and automated systems recognize areas where selling pressure has appeared before. When price approaches such levels again, reactions tend to be decisive. In this instance, the ceiling held and silver retreated. This does not automatically determine the next long-term direction. Repeated rejection at the same level, however, establishes that area as a contested zone. Movement above it would indicate a structural change, while continued failure below it increases the likelihood of choppy and volatile trading. At this stage, the event serves as a warning signal rather than a definitive conclusion. The rapid decline forced decisions across the market. Late buyers were pushed out of positions, leveraged traders saw stops triggered, and short-term strategies collided with longer-term expectations. This type of forced decision-making often results in increased volatility and emotional responses. The distinction between trading a short-term move and holding a longer-term position becomes critical in such conditions. Short-term capital exposed to sudden price swings is vulnerable to abrupt reversals. Long-term positioning, by contrast, is structured to withstand intraday volatility. Misalignment between time horizon and capital structure can amplify losses when markets move quickly. This session highlighted that risk clearly. The role of institutional communication also warrants attention. Bullish targets released by large banks can serve multiple purposes. They may reflect long-term outlooks while simultaneously contributing to short-term price fluctuations. Institutions can maintain constructive longer-term views while still benefiting from short-term volatility. The release of optimistic projections can expand the pool of buyers and shift perceptions of value, even if the immediate market reaction is negative. The pace of the decline provides another important signal. A rapid drop typically indicates forced selling rather than a gradual loss of confidence. Fast moves often clear positions quickly, creating conditions for more stable price behavior later. Whether that stabilization develops depends on where price finds support. At present, silver has not broken decisively below its recent range. Initial support has formed in the upper 70s, with a more significant support area located in the mid-70s, where previous consolidation occurred. These zones will be closely watched to assess whether buyers step in or whether selling pressure persists. Gold prices also moved lower during the session, indicating that the silver decline did not occur in isolation. Broader pressure across precious metals suggests a wider market influence rather than a silver-specific event. Historically, silver tends to move more aggressively than gold, both on advances and declines, and that characteristic was evident in this session. The focus now shifts from intraday volatility to broader structure. Large price targets can attract attention, but also increase volatility by drawing in crowded positioning. Crowded trades create opportunities for rapid reversals. Process rather than price levels alone becomes essential during such periods. As trading continues, attention will turn to how silver behaves around key support levels and how it responds on a weekly closing basis. Daily fluctuations may generate noise, but the weekly close provides clearer insight into whether the broader structure remains intact. That evaluation, along with risk discipline and positioning alignment, will shape how the next phase unfolds. With those immediate dynamics established, the discussion now turns to how these movements fit within broader market behavior, time horizons, and structural signals, which will be examined in the next part of this report. As we continue this report, the focus now shifts to what the market behavior itself revealed after the sharp reversal, and why the timing and structure of the move mattered as much as the headline that triggered it. The rapid sell-off that followed the spike was not gradual or hesitant. It unfolded with speed, indicating that selling pressure entered the market forcefully rather than organically fading. This distinction is critical because slow declines typically reflect buyers stepping aside, while fast declines often signal forced activity, such as stop losses being triggered or leverage positions being unwound. In this case, the pace of the drop suggested that liquidity was being pulled quickly from the market, a process that often follows periods of heightened participation driven by public enthusiasm. The article emphasizes that the market does not respond to news in isolation, but rather to positioning. The presence of a bullish headline alone does not dictate price direction. Instead, price reacts to who is already positioned, who is under pressure to act, and who benefits from increased participation. When buying activity accelerates sharply following a widely circulated narrative, it creates a pool of liquidity. That liquidity, as described, becomes valuable to larger participants seeking to exit positions efficiently. Rather than selling into a thin market where price impact would be severe, exits occur when volume expands and demand appears abundant. This process explains why strong headlines can coincide with sharp reversals rather than sustained breakouts. The article makes clear that the move toward the low 80s in silver was not random. That area represented a previously tested level where selling had emerged before. Price memory plays a role in market behavior, as traders and automated systems alike respond to historical reference points. When price approached that zone again, it encountered resistance. The failure to break decisively above that level resulted in renewed selling, reinforcing the idea that the ceiling remained intact. A second rejection at a known level increases its importance, turning it into a focal point for future decisions rather than a point of confirmation. At the same time, the article avoids framing the reversal as definitive proof of a broader trend change. Instead, it raises a central question without answering it prematurely: whether the move represented a routine pullback within a larger bullish structure or the early stage of a more severe decline. The distinction depends not on headlines or targets, but on how price behaves at key support zones. The initial reaction pushed prices back toward the high 70s, where buyers appeared to slow the decline. That area is described as the immediate floor, a zone that will be monitored closely for signs of stability or further weakness. The broader context also matters. Gold prices declined alongside silver, indicating that the move was not isolated to one market. However, silver's decline was sharper, consistent with its historical tendency to exhibit greater volatility. This characteristic amplifies both upward and downward movements, making timing and position sizing particularly important. The article underscores that volatility is not an anomaly but a defining feature of the market, one that participants must account for rather than react to emotionally. Another critical theme addressed is the mismatch between time horizons. Public targets issued by large institutions often reflect long-term views, while many participants operate with short-term capital or leveraged positions. This disconnect can create situations where a long-term bullish narrative coexists with short-term price declines. The article notes that multi-year expectations cannot be effectively pursued with capital structures that are vulnerable to daily fluctuation. As a result, sharp pullbacks can occur even as broader narratives remain intact. The discussion also highlights how bullish narratives can shift perception by anchoring expectations to future price levels. When attention centers on large target numbers, current prices may appear inexpensive by comparison, even if they are extended relative to recent ranges. This shift in perception can accelerate buying activity at inopportune moments, increasing the likelihood of reversals once selling pressure emerges. The article frames this process not as manipulation, but as a predictable outcome of how information and incentives interact in financial markets. Looking ahead, the article emphasizes observation over prediction. The key levels to monitor remain clearly defined. The high 70s represent near-term support, while the mid-70s mark a more significant zone tied to prior trading ranges. A sustained failure below these levels would indicate a change in structure, while repeated defenses would suggest ongoing interest from buyers. The outcome depends on where price refuses to go, rather than on where it briefly trades. The article also stresses the importance of higher time frames, particularly the weekly close. Daily volatility can obscure the broader picture, while the weekly structure provides clearer insight into whether prior breakouts remain valid. A close above former breakout zones would indicate continued structural strength, despite intraday turbulence. A close below them would signal that the market requires further adjustment before attempting another advance. As this report concludes, the central takeaway remains discipline. Volatility, as described, is a tool that tests emotional responses. Rapid advances invite chasing behavior, while sudden declines encourage abandonment. Both reactions can result in unfavorable outcomes. The article reinforces that risk management, position sizing, and clarity of intent are essential, especially during periods of heightened attention and rapid price movement. This brings us to the end of the detailed breakdown. The market reaction to the bullish headline, the subsequent reversal, and the levels now in focus collectively illustrate how attention, liquidity, and positioning interact. In our next segment, we will summarize the key observations and outline what market participants will be watching as conditions continue to evolve, based strictly on what the price action itself reveals.